In my free time, I'll do that. So today we'll cover the fixed income, and as well as I would like to touch to the corporate action. We have already discussed corporate action, but here we'll discuss corporate action in a way like, a pre-corporate action, what was the holding, and post-corporate action, let's say what is the holding and what are the numbers, and how that, let's say, event is impacting on the net assets value of a fund. So we'll discuss 10 to at least 5 to 10, or I would say more than that, even if we can cover. So we'll try to cover that and to see the impact analysis of actions on the net assets value of a fund. All right. And apart from that, interest payment. So let's take the example of, let's say, where is your statement? This one. Did we? Okay. So GMT fund is holding, we are assuming it, one CLO tranche. CLO, it means collateralized loan obligations. The loan backed by or with the security. So that loan, you can call it as a collateralized loan. When we say collateral, it means it's an asset. All right, asset. And if you take a loan on that collateral, so that become collateralized loan. So it means you have a signed collateral or transfer collateral to get a loan amount or advances. So that loans, you can call it as a CLO. Let's say you have one signed CLO, PCS, for 10% interest payment. Right. So this interest payment is, let's say it's a fixed. All right. There is one more, let's say, instrument, which is FRN, government T-bill, at 7.5% rate. All right. So this is kind of a market risk, right? Right. Then let's say JPN or JPY, government note, at 9% interest rate. Let's say which is mm, not fixed. Let's say again market risk. Finally, Indian government NHI, National Highway Authority of India, bonds at 9% interest payment, which is fixed. All right. So investment is also important to set up accruals in your system. Investment value, or you can say cost of investment, or acquisition value also. All right, cost of investment. So cost of investment, it means basically purchase value. While setting accruals, you need to ensure, two things, means apart from this. One is purchase value, another one is let's say redemption value. Redemption value. All right, and then your quantity. then only you can set up accruals in your internal accounting system. So let's say investment value. If you want to calculate investment value, then you need to calculate first. Do one thing, market price. Market price of instrument. Right. So we can say per unit price. Per unit price of a bond. Let me fix this one. Fixed. And so let's say CLO price, which is in a CLO, you cannot calculate in quantity, as simple as that. Means loan you cannot calculate in quantity. So always you would calculate in fees, per unit and fees. Then wording would be fees, it means actually principal amount. Let's say you have purchased this loan, which is 1 lakh. Interest payment that you know it, which is 10%. So investment cost, if condition is if you have paid any interest expenses to the seller, right? Then only you can means add that interest expenses in the investment, and then your investment value would be, your purchase cost would be different one. So let's assume it how this will work. Let's say there is a B, and your fund is like GMT fund. That's right. So interest payment, which is a 10%, let's assume it. One person that or A hold investment January to March. B hold, let's assume it, April to June, and GMT fund. So that GMT fund hold investment, let's say from July to let's say September, till September you can say, or maybe let's say for next quarter also that you are in plan to hold it. July to December you have this target, let's assume it. Now if you see here, the issuer is TCS, so it means TCS will make a payment on yearly basis, right? TCS will make payment on yearly basis. But when this A purchase loan during this first quarter Q1, so this person will expect, because if you say interest payment, if I calculate interest payment, which is 10% divided by 100, so that becomes 10,000 for per year. And if I put it into the quarters or maybe months for that matter, so that becomes 833.33 rupees. So if you see this person hold investment for 3 months, so it means if I multiply interest payment into 3, so that becomes 2,500. So this person original investment is 1 lakh, right? Original investment is 1 lakh, but when this person means A will at the time of selling this investment to B, this person will expect 1 lakh 2,500. Why? Because here if you see every counterpart expect principal plus accrued interest on investment. But here if you see, issuer is not going to pay interest payment directly to the A at the moment. Why? The reason is he now want to sell that investment to the B, or maybe let's say C or D, whatever it is. And that's what TCS is not forcing to the A to sell this investment to someone else, because TCS has already planned their interest payment where they'll make a payment on a yearly basis. So why TCS will push someone to do it, right? So it's a it's prediction, let's say, that is he has done and he got a big opportunity for investment, then of course he will try to sell his investment in the market at current price, and he will try to get his money back so that he can invest in other financial instruments. So that's how that investment things works, or that comes into picture. And here if I say 1 lakh, so this 1 lakh while selling A to B, he will expect he will expect 1,25,000, which is a cost of investment. So now if you see, if the B want to buy this same loan, B want to buy the same loan, then B will buy the same loan at this price. So it means B will record cost of investment in the books of B with this amount. Why this amount? As I said, principal, which is 1 lakh plus accrued interest, and here B will again consider interest payment as an expense, and investment would be which is 1 lakh, and that's how we can convert that interest expenses into investment. So that becomes your capitalization of expenditure. All right. So now when the time comes, for a GMT fund, let's say GMT fund is interested to invest in this particular CLO, TCS CLO, then GMT fund will have to make a payment to the B. But how much payment that GMT fund will make then? Again, GMT fund will have to make a payment.
1,05,000.
Not, yeah, 1,05,000. Yeah, addition, it would be 2,500 for this quarter. So it means here GMT fund will purchase same loan with this price, 1,05,000. And that's how you can record this price in your books of account. This is the one way to record it. If not, then how we can record it? If you don't want to record it like this, then what you can do, record the pure face value, which is 1 lakh. So record the face, and for interest payment 5,000, just directly convert that into expense. That's fine. So you have paid 5,000. You have paid 5,000 to the counterpart. Now if you see here, fund managers always apply even that IRR method also. IRR, it means they charge time value of money. The reason is, if you see, this money fund manager will receive after 6 months. But fund manager means in the month of January 2024, TCS will make an interest payment to the fund manager, GMT fund. But now GMT fund manager is paying interest payment to the B, which is advance payment kind of that GMT fund is making to the investor B. And that's when your IRR here, that fund manager can apply. Listen, so it means the statement would be, hey guys, listen, we are paying advance amount, means 5,000 to the B. But anyways, the TCS will pay that amount to us up to 6 months. So we'll apply the time value cost for a 6 month, calculate the IRR for a 6 month and take that amount only. The reason is I have paid advance, means 5,000 amount in advance to the B. Eventually that would be our loss because of time value of money. And always fund managers, they try to get exposure of time or that cost, I would say. 6 month cost will apply, and that's when you try to calculate your return, that amount goes around 5,000 cost of, let's say, investment, right? When the fund manager applies it, and you when calculate it, but when the fund manager calculate it, so fund manager always consider IRR. It means time value. Fund manager will apply the cost, let's say 10% cost for next 6 months. Fund manager will apply it and discounted that cash flows. So this is how you can, interlink with, if you see any amount which is not matching as per your simple calculations. So it means there is a very high possibility where that fund manager considered the time value of money cost, or maybe DCF in simple, that you can say fund manager applied discounted cash flow to that amount. He just discounted with the rate of, let's say, whatever rate, but yeah, you can confirm the rate. So in most of the cases, fund manager consider that risk-free rate, it means treasury bills rate, this rate. So this is becomes, if the security, now in Indian government treasury bills rate, you will have to check it. If you now ask me what is India's risk-free rate, go and check it on the site where, let me see, Indian government's T-bill rate. See this is our risk-free rate, right? Which is at 6.85. If I talk about US risk-free rate, 2.6, 1 month 2.6, and 1 year 4.1. So in a days they calculated basically. If I talk about Park government, 7.8%, which is high. Then if I talk about FRN, France, two government index rate and spread, they have a different calculation. Floating rate, let marketable securities. I'll check it for the government. UK 30 over 30, 30, 30, 30. Moody's Analytics. Variables, United Kingdom. I don't see the data here for lending rate they have given, which is 5.5. But T-bill over 30 days 0.5. Monthly they are calculating. If you put a monthly, so it goes around 6% something. 0.5 for per month into 12, so it goes around 6% annually. So, right. So these are the free risk-free rates. So the point here is, so always fund manager expect that if I put that 5,000 in the, let's say, that government security, so government security will pay 6% return, 6% return for year. And here, if you see this, fund manager is paying interest payment for last 6 months in advance, and that amount fund manager will receive in after 6 months, and that's when he calculate the discount, whatever rate that you would see, let's say 3% divided by 100. So this is how fund manager will discount the cash flows. So it means, as per the fund manager, see again, all are theoretical calculations. So that all calculation happened in the fund manager's mind only. So that assume it, okay. So I need to consider the cost of investment, which is 150. So I'll adjust that. So net interest which I have received, or income which I have received, which is 4,800. Instead, this fund manager will ask you to record this one when actual TCS process payment to the GMT fund. So GMT fund will ask to record it this payment. So you would see such a conflicts, but always try to ask questions: why we are doing this, and what calculations or information or input that you have referred to calculate interest payments and all. Because those are the small things. If you just avoid it at your level, so that will lead to the bigger scam even, right? Because we as an accountant, we are responsible to maintain the accurate bookkeeping records for that investment, or maybe any anything, any transaction. If you see in the books of fund, we are responsible, we are entitled to do it legally also, and that's what they hire as an accountant. So it means we are the person where we can ensure everything, all that information is accurate. And if you're not satisfied with that information, find a way and always try to ask fund manager to, confirm it or provide supplement. If not, provide confirmation why we should go ahead with this calculation. Then I can update it accordingly in that way. Anyways, so this is how you would see, investment works. But here I'll say, if you want to record fees, you can record it fees. If you don't want to record it fees, then you can directly consider this amount as a investment or purchase value of investment. So that depends. Or maybe, as I said, that unit price or fees can be different, or your investment value or cost of investment or purchase value or acquisition cost, all are same. Acquisition cost, all are same. So you might see where you need to record 1,05,000. So it means already you have paid interest payment in advance. Second thing, redemption value, of course it would be this only face value that you will receive. Quantity, as I said, this is a CLO. So in CLO, you don't need to record quantity. It's in a loan obligation. All right. And then interest payment. Interest payment you can calculate on your actual that face only, not the investment, total cost of investment. So calculate it, which is a 10,000. So 10,000, it means sometime while calculating interest payment, so you would see where, monthly rate which they have given. Monthly, it means how they calculate, I'll tell you. Let's say annual interest payment rate is 10%. Right. If I ask you to calculate this rate month wise, so that becomes this 12, 0.83 for per month. Right. If I ask you to calculate this, day wise, so calculate day wise, for per day interest payment would be 0.02%. So on same amount, investment amount 1 lakh, you can calculate day wise interest payment and see your interest would be 27.77 for per month. So while updating your book or while setting accruals in the fund accounting system, I'm sure you might see, this table where you need to update months, you need to update that product interest payment, you need to update that fees value, you also need to update the cost of investment, means how much cost that you have paid to the, to acquiring that particular investment. You need to record that as well. And apart from that, while setting accruals, sometime you can directly record, or set up that accruals with the amount. Amount, it means the amount, right? The amount where, let's say, fixed amount interest payment, which is 10% on 1 lakh, that becomes your 10,000, and 10,000 divided by, if you just divide this amount, 10,000, let's say, in amount, if you set up the accruals, what happened? Let's see, 10,000 divided by 12. So that becomes 833, and 833 divided by 30. So this is becomes 27,000, sorry, 27 rupees interest payment per day, per month. And fees. Not fees, my bad, per year. Now, depends on your accounting cycle. If you have a yearly accounting cycle, then you can directly update, year end payment date, or maybe year end, every accounting firms, they close the accounting. If you have a Jan to December accounting, then on December your accounts will close. So it means 1st of January to 31st of December, that period you can update. Start, system required details like start date and end date. Update that, and end date would be January to December. And then you can directly, I mean, system, see, once you update the date, system will directly pick up the 10,000 amount. So you don't need to split that amount then in a percentage. You don't need to do that. Right. And if I talk about, let's say, monthly wise accounting, if you have a monthly wise accounting cycle, then you would see monthly accounting cycle. Let's say January, the start date would be again remain same to, let's say, 30. Yes. Again, here also, again, you need to select the convention. Convention, it means, so there are two
So
to three.
that last day will be 31st of Jan. The Jan is having
I'll come
31
to
day.
that point. So I was talking about conventions. We have a different conventions. Conventions, it means, let's say 30 divided by 360, right? Why 360? So it's an assumption where you can consider every month with 30 days of interest payment. That's it. And if you see 360 divided by 12, so that becomes around 30. So it means every month you can calculate interest payment for 30 days only. Even if you see, 29 days, 28 days, or 31 days, that's fine. You don't need to worry about that. So it depends on the convention. Then another convention is actual to 360. In case of actual to 360, what will change? Then here you need to change the date. So it means you can go month wise. For example, let's say Feb month is for 28 days. Then you can consider 28 days only. So you can calculate interest payment for a 28 days then. Your system will calculate it. So that's what you need to set up that accruals. To set up accruals, it means to set up the conventions, interest payment, security, and everything. So that system will calculate interest payment for you. And how you can select these conventions? Of course, on the basis of agreement, on the basis of that investment scheme. Investment schemes provide that how that investment schemes want to keep it their interest calculation convention, whether it is 30 to 360 or actual to 360. You might see term like actual to actual as well. Actual to actual. So what is the difference in this actual to actual? Actual to actual, it means in 1 year you might see 360 days, and in other way around. So you might see 365 days or 366 days also. So that becomes your actual to actual. But what I have seen, generally what happen, I'll tell you. In a private securities, you would see 30 to 360, and in a government securities, you would see actual to 360 or 365 GSEC. But this is not a kind of a legal rule something. But yeah, either of the one you will have to select. That's the legal term. Legally, you are abide to elect that option what you want. Actual to actual, 30 to 360, 30 to 365, actual to actual, what you want. So you select it. And that once you select that convention, then you cannot modify it, you cannot alter it, you cannot change it. Simple. Once you select, then you cannot alter it, you cannot change it, you cannot modify it. And if you want to modify, then you will have to take approval from the regulators. All right, hey, we want to change that because of this and this reason, and you should have a substance uh, sales with you so that you can justify why you want to change that. Now your question would be, if I change, then what will happen? If I take the example, of this, let's say, if I talk about January, in January, you would see 31 days interest payment. If you see, it looks like 861. In Feb, you would see 28 or 29 days. So I'm assuming as a 28 days. So it becomes 77. So that change you would see in interest payment. Right. So convention matter a lot. What if the amount is very high? Let's say interest payment amount is, see this change then. This will affect a lot. Now, if I calculate the difference between these two, see, if the amount is small, so that feels like okay, that's fine. $83 or rupees, which is a fractional amount which can be adjusted, that's fine. But what if the interest payment amount is high? So in that case, make sure while changing your convention or selecting your convention, make sure that you have verified all the required documents or backups which can provide you confirmation that this is the convention. If there is a change in convention, then that will affect, and which is a critical task, so that will affect on your net assets value of the fund also. Apart from that, see, to affect to validate, like, whether which is impacted or not, apart from that, I would say again it's a regulatory breach also, that you are recording your incomes or accruals in a, let's say, in an incorrect way, and that is the failure of bookkeeping. So that's what convention interest payment that matter a lot. All right, so now depends on your accounting cycle, so that you can select your accounting accruals, or you can update that in the systems. And once you update, then across months you can spread that. So one way that is you can update rate. If let's say as per the system you don't need to update the rate, then you can update the amount. So there are two ways only: one, update rate, or else update amount. Again, this guidance you can see, in initial draft, fund manager provides it how you want to update your accruals in the system, amount wise or else rate wise. Means you can update that as per the option given in the initial draft if you want to set up the accruals. Let's say if you're from that NAV calculation team, then you don't need to set up the accruals. Then you can just validate it. Whatever accruals which has been set up in past, you can just validate it, verify it, and then post the accounting entry. If it is a monthly wise, then you can calculate monthly interest payment and post the accounting entry. If it is a daily wise, then calculate the daily interest and post the accounting entry for accrued interest, right? Receivable to interest income. So that's the different story. Depends on the accounting cycle. Lot of things,
Shiv,
Yeah, go ahead.
though we have a monthly accounting, let's say our fund is doing, monthly reporting, but though we have to calculate the interest on daily basis, because means I'm asking the question or rather telling you, let's say in middle of month, if the fund, okay, this fund sold out this security,
Mhm.
so we should have that accrual balance with us. Is that so?
Yeah.
So irrespective of we are doing it on reporting on monthly, yearly basis, but we have to calculate it on daily basis, right?
System calculates it. So in a systems, you can take it, how you want that calculations. In case of, if I talk about Geneva, in Geneva, just click on take daily, even hourly. If you want to calculate, click on hourly. Few systems, they have integrate, that facility. Even they calculate hourly basis interest payment also, and which is very, very feasible. But daily, yeah, so you can select the daily, then your monthly, yearly, quarterly payout. The date is already given, then select the dates like quarterly, and then apply it. So system will calculate daily basis then for you. So you don't need to calculate manually anything as such, but you can calculate manually to verify with the system whether system calculates correctly or not. Sometimes due to technical issues, system calculated accruals, let's say, which are wrong, and you didn't check it. After 1 week, once you receive escalation, then you got to know. So that system projected or calculated accruals which are incorrect and that you reported in NAV. So that's what manual calculation come into picture. And in case of, if you, let's say, fund manager sell that security within a month, let's say, up to 15 days or maybe 10 days, then you can calculate interest payment for a 10 days for that particular matter, for that particular transaction, then apply it. So one more important, thing that I'll show you something or I'll draw something so that you can understand. But yeah, so here then you can, now update the schedule, interest payment schedule. But in a system, once you update all these details, system actually spread that interest payment across all months. And here we have 10,000, which is interest payment. Per annum interest payment, we'll see how much it would be accrued and all. Split that across 12 months. 830. This one. To update your schedule. So let's say, same example, let's take it in another way. All right. So here you also hold this investment, same investment. Right. Where is that? Yeah. EBC, where is the GMT fund now? So GMT fund want to sell the CLO. And let's say there is a fund which is called St. Paul. So St. Paul fund manager is interested to buy this fund, buy this particular CLO. Right. Interested in buy. But if you see, you have already paid the interest payment for this one, and you have also served Q3, but in mid of October, not mid of exactly, but let's say today, that you have decided to sell. Decided to sell. Sell CLO. So once you decided to sell CLO, so it means you will already you have, so it the interest payment, right? So 2,500. Let me check it. Yeah, 2,500 for this quarter. You have already paid it. 2,500 already you have paid it, and here you would expect 2,500 as interest, from the that particular seller. And apart from that, let's say in your system you have calculated accruals for across all three, but if you see there's two accruals, ultimately you will have to remove it. Why? Because you decided to sell the security on this date. You have decided to sell the security on this date, so you can create accruals in the books of fund. Calculate the interest payment. So on the basis of conventions, 833 divided by 30. If you have a 30 to 360 or 30 divided by 360 conventions, per day interest payment would be 27. And assuming that, including your Saturday, Sunday also, assuming that 1, 2, 3, 4, 5, 6, and today is 7. So I'll calculate the interest payment for even trade date also, so that I'll receive it into 7. So 194 plus total, if you see, so you would expect interest payment this amount, 7694.44 from the buyer of this in a particular CLO. So it means St. Paul fund manager will pay you, if you see, St. Paul fund manager will pay you here interest payment plus this amount. So total 1,07,694 rupees that will receive to the GMT fund. So this is how your accounting works with fixed income instrument. And now once you receive this one, how your accounting equation changes, say this. So GMT fund first, GMT fund book, it will record accounting entry at the time of purchase loan, investment in CLO account, investment in CLO account debit to interest expense account debit to cash account credit. And go back and just check it. Accrued income. So here in the books of GMT fund, you can record this amount. Total cash fund manager paid 1 lakh. Investment in instrument would be 1 lakh plus 5,000 as interest. So this is how you can record entry at the time of purchase. At the time of sell of CL.
Sure. A small doubt here.
Yeah.
Okay, not for this entry. Can you please go to that tab where you just, we have the calculation. Okay. So in touch column, okay, where you highlighted those numbers, 7694144, right? So Saint Paul will start accruing in his book interest, okay, from trade date or settlement date.
Depends on the accounting cycle, but in most of the cases from trade date only, so that trade date only, it means on trade date I would be the owner, so it means existing owner would be, so that person would be. But in most of the, with the fixed income securities, they calculate from the settlement date only. So on settlement dates, that buyer will start accrue the interest payment in the books of account. So till
Okay.
settlement date, even though you can accrue interest payment for you. But what if the
So in this
counterparty?
example, we will assume, means we are assuming that it is settled on 7th of October itself.
The government securities, it will settle on same date even. So now we have a settlement rule which has been changed. But yeah, in private securities, you might see T+2. That depends on the settlement cycle. But yeah, buyer will accrue the interest payment on or after the settlement date.
Okay, for fixed income, you are saying, or
Yeah.
T-bills or governments.
Yes.
Okay.
Depends on.
And
And
it
this
change
rule is
on what
also
type
not
of securities?
this. Sorry.
This rule will means change apart from government or fixed income.
Hmm.
Means for other type of security or investment, it will change, right? Some for some securities, it will start accruing, buyer will start accruing from trade date only. Is there any
Yes, it
other
can
way?
happen. See, it's not a fixed rule. It means it's an option, right? It's an option where that depends on the issuer. If the issuer comes with like, let's say, it's a traded basis accounting cycle, and same way their investment manager advise them keep it traded. So it means traded becomes the uh, deadline date, right? So trade it only that buyer will start to receive interest payment.
So it depends on the investment manager. It doesn't depend on the instrument that they are investing.
Instrument plus investment manager, it means underwriters, that's what I said. Investment banks, so investment banks advise to the that issuer, TCS will appoint their investment manager or advisor, right? Or underwriter, you can say. Underwriter, at the time of underwriting, they provide that framework. See this, look, this is the instrument, you can keep it in this way. So this will then comes as an announcement for you guys, then you can follow the same. Sometime you would see this requirement comes from the OTC market agents as well. Let's say, for example, Citibank is the agent. So Citibank can design that framework and submit that to the TCS. So TCS management will approve it. This will apply across all their, that investors as well then. And then that date becomes a deadline date then, a market deadline date, which is set up by the agent, or agent deadline date that you can say. Agent set up a deadline where on the basis of trade date only, you can calculate the interest payment. Trade date to trade date. So it means here, let's say we have purchased securities on, assume it, 1st for January 2023, and we have sold the securities on 31. So in this case, you can calculate interest payment for 31 days directly. So this is becomes your trade date to trade date. Trade date to trade date. So you can calculate interest payment till the trade date of your securities. Means from trade date to till your next trade date. Then in case of settlement date, same, let's say you purchase security on 1st of January, but that security got settled in the books of account on, this is the scenario, right? The same applies to the, at the time of sale. Let's say you sold that security on, and settlement date is, assume it, just T plus 1, we are settling on the basis of that. Just assumption, okay. 1st of December 23. What will change in this case? If you calculate days from 2nd, January to till 1st of Feb, I'm sure it would be around 30 days only, 31 days, if I'm not wrong. Just check it. 2nd to 28, so this becomes your 29 days. 29 plus
31 days.
31 days only, right?
30, yes.
And there is no change in days. Even if you go this way, or that previously we calculated, exactly trade date to trade date, so there won't be any change in the calculation. But it depends on the that agent, because in a fixed income market, agent actually provide that facility, to the issuers. Issuers appoint agents for their particular securities, and then issuer comes with certain limitations or restrictions, and that restrictions you will have to follow it while dealing with that particular securities. If I talk about dividends, who announced the dividend record date? Company announced it, not stock exchange. But stock exchange announce the ex date. Similar way, see, stock exchange and the company, they come together, they discuss the terms and conditions. Company board also approve it, and stock exchange also approve it, and then same will roll out. Means that notification will roll out and communicate to all stakeholders, including government bodies, regulators, investors, and everyone. And everyone, they will follow it. In fixed income market also, same uh, way of communication that I would say, and that way need to follow. You would say sometime trade date to trade date also you need to record it. Sometime you need to say that you need to record that settlement date to settlement date. All right. So did you get the answer, or still you have any confusion?
No, I'm good. I'm good. Thanks. I'm clear with all my doubts.
Okay. So here then at the time of sell of loan, so if you see same transaction, just take it. Accrued income. So we have received this one. Take it here only. So once you sell, then cash, of course, that will receive cash account debit to credit to uh,
Income.
interest interest income credit. So here you can record total 1,76,944. So this is how I can record. But actual income, if you calculate how much income that you have received from this particular transaction, then your net income would be net income that I'm talking about. That would be uh, this amount minus this amount. So this becomes 26,954. Apart from this, you might see broker fees, agent fees, other expenses also. So that you need to consider, right? Investment comes with cost. No one offer any service free of cost. So their expenses also you need to debit. Let's say I'm just taking that it's just an assumption again. So you would see a lot of assumptions. You will have to assume it. Uh, let's say expense incurred. Let's assume it 200. So that 200 you can again. So now 24,944. This becomes your interest income, net interest income, net income. And so this net income, again, if you have a IRR system, you will have to apply DCF factor. And that's what nowadays, IRR and DCF. So that is kind of, it's a regular practice now in PE or in even for that matter, hedge funds or any other investment vehicle like SPV and all. So they consider it. Why they consider it? Already we have discussed around it, right? Why they consider? Because if they don't consider, then ultimately this net income is eligible for tax, right? This net income is eligible for tax. Then why should I pay tax then? Now if I apply 10% discount, so that becomes 249. Then let's say, see this in, you cannot charge to 49 directly discount. The reason is only you hold this investment for, I believe, 3 months around, right? Split that fees across first, sorry, my bad, 12 months, because this was for an entire year. So split that across months, then again days also. Split that discount across days as well, so that becomes 30. And now you can calculate. So as I said, you have holded this investment for 3 months, so into 3. And apart from that, you have also holded this investment for 7 days. So calculate discount for 7 days also. So that becomes, do this sum, 67.21. So apply the discount DCF. So you need income after IRR, so that becomes 2427.233. And this amount is eligible for tax now. So this is how your calculation works. This is how you, even though for that matter, in case of any calculation, you need to consider that net amount and update your books of account, and even though accordingly, prepare accounting entries and update it in the books of account like this. And if you don't know why, how, then you cannot relate that even, right? So depends here in the fund accounting cycle. If you see, the most important aspect is accounting cycle. It can be daily, it can be monthly, it can be quarterly, yearly. On the basis of that, your equation changes. All right, and then you can prepare accounting entries and update. So that's the simple task. And same, if you see, same you can apply it to the other financial instrument as well. This was just for CLO. I'll take one example for in case of FRN, government T-bills. So if you see uniqueness in between all three, T-bills, which is for a short term, GPY government notes, it means Japan government notes, which is for a mid-term. Mid-term, it means this is for only 12 months. Within 12 months, government will redeem it. This is for 12 to 5 years. And when we talk about bonds, that means it's for 5 to 10 or maybe more than that. So it can be for even 100 years also. If it is 100 years, then that becomes a perpetual bond. Right? Redeemable, irredeemable. So that irredeemable bonds becomes your perpetual bond in that case. The bond will not redeem before the 100 years of time span. And this is for a long term. Right? Then I would like to take this example again with the accrual calculation. So you will have to set up the accruals for all fixed income securities. When we talk about fixed income securities, it means what are the different fixed income securities that we deal with it on a daily basis. Money market, all money market instruments. So those instruments which you can consider as a fixed income instrument, because money market instruments, they offer interest payment, and that's what you can consider them as a fixed income securities. Apart from that, all bond market securities, that also comes under your fixed income. Means money market, bond market, both the markets, that comes under your fixed income. Apart from that, loan market also, that comes under your fixed income. Apart from loan market or loan segment or vertical, there is a one more thing, which is a deposit. It can be corporate deposit, it can be national scheme certificate deposit, or it can be any private institution also can launch any deposit scheme. That also comes under your fixed income, including your normal deposit which you have at the moment with the XYZ banks. That product also comes under your fixed income. So fixed income, which is not limited to the bonds only. This is just your, most of the people, what they assume, like only that bond market comes under the fixed income. No, money market, loan market, your normal deposits and all, and then CLO, CDO, ABS, MBS, and the other, if you see any obligation as such, if that obligations contains the information like fixed income cash flows, and then that becomes your fixed income securities. Simple. All right. So if I take the example of France government T-bills, so it means, so this interest rate, it will change on a quarterly basis, and that's what you would see type like market risk. Market rate, it means this particular instrument is carrying market risk. At the moment, let's say T-bill rate. January Feb, March, April, May, June, July, August, September, October, November, December. So you might see rate like 7.5, 7.2, 7 point, let's say 6, 8, 8.1, 6.2. You can see the, means changes in the interest payment like this. Yeah, right. In the month of October, 9 point. Months, right. Mm. This is your T-bills interest payment. So if you see every month, central bank of that particular country announce the rates. Right? Maybe sometime you would see quarterly, sometime you would see monthly, depends on it, and sometime it is depends on the market demand as well. Let's say central bank announce interest payment which is 9.7, but what if the people or investor they are not interested to buy T-bills, market rate which is say 9.7, but sorry, central bank's rate which is 9.7, but in market you might see the discount as well, right? So it is depends on the say in a secondary market that security works in a different dimension, or I would say different way altogether, because government will pay interest payment as per this interest payment, means 9.7. Government will pay interest payment in the month of October as per the 9.7. But in market, in a secondary market, same security, same T-bill, buyers or sellers, they are dealing with 9.2. This happened. The reason is if the security interest payment is high, then see, most of the people even they'll not show their interest to buy the security as well. So there are different aspect also. So it means ultimately that will affect on the price of the security, and then price means that price should be kind of under price, and with that price, then you might say buyer and seller will start transferring securities to each other. But yeah, so this is how your security prices changes. What if this is a quarterly game then? If it is a quarterly game, then it is, let's say in first quarter price was this. And January, Feb, March. Let's say in quarter two, price was this. Quarter three price is this. And quarter four. So this new rate is this now. quarterly, if you set up this market risk or interest payment, all right, this is how you can see the change, all right. So that you can consider interest payment for that particular quarter and then calculate it. So it means why this understanding is important, I'll tell you. So if you calculate the accruals in the month, or let's say in first quarter, I'm sure your accruals amount, it would be different. Why? Take the same amount, which is 1 lakh. In first quarter, if you calculate the interest payment, so you will have to calculate interest payment with this rate, right? And if I calculate the actual interest payment for this particular quarter, so it becomes 1875. Same thing, if you see, if I calculate interest payment in the quarter 2 with the market rate,
Same divided by 3. You will divided by 4 in K column.
4, because we have 4 quarters, right?
Sir, right. Sorry. My bad.
1 lakh into 7.2 divided by 100, 7,200 divided by 4. See this change in interest payment. How means market risk create impact on your investment or returns, I would say. $7,600. Oops, it was wrong. 2,000. And now let's say if you're calculating daily interest for that particular month, then again your equation changes. This is for 90 days, right? Then divide with 90. So this will become your daily interest payment. See, investment amount is same, but due to the market risk or market rates, so your interest calculation also, it will change automatically. That's how market risk affects on your investment. Same you can apply to the other quarters as well. And I'm sure definitely you would see the change. 21 rupees. 20 rupees. 20.8 rupees. So this is becomes your daily interest. This has become your quarterly interest. Quarterly. And this is
So in J column, it is annually, right?
yeah.
And in K column, it is quarterly for 3 months, right?
Yeah. Yearly, quarterly, and daily.
So for quarterly, for let's say for Q1, yearly is 7,500,
Yeah.
right?
Correct.
So quarterly it becomes divided by 3, right?
Divided by 4 means yearly. In if you want to calculate yearly, so simply multiply with this interest payment rate 7.5.
No, that is fine. I got the calculation. So yearly it is 7,500.
Correct.
So if we divide it by 12, we will get it for 1 month. And if we will multiply that by 3, so we will get it quarterly, right?
Yeah. I'll just take one. Just this is becomes your monthly.
Right. Right.
So if you want to calculate quarterly,
Multiply by 3. Got it.
so this is how we set up. Means all calculations you will have to set up in system. Whether it is a market risk security or whether it is a fixed income security. In both the cases, you will have to update security price or security, let's say, interest payment convention, the other key details like fees and everything in the system. And in case of fixed income securities, what will change? See here. So let's assume it. You have a security which is a foreign government bond with the price of 1000 for per unit. So you're holding 100 quantities, we're assuming, right? Then redemption value would be again same. There won't be any change in the redemption value. But in case of, you would see two different ways. If I talk about T-bills, one, you might see here the price should be different. So that becomes a discounted price. And here you might see face redemption value, it could be different. But anyways, here, so the difference should be your interest payment eventually. So I'm assuming there is no change in the redemption value because this particular FRN in a government T-bill which is offering say 1.5% interest payment for per annum. And then investment cost. So we are assuming here, so we have directly purchased from the agent, so there wasn't any due interest payment on this security. So there is no interest payment cost. Quantity into price. So this is becomes your investment cost. And then calculate the interest payment. 7.5. 7,500. But so as we discussed, if it is a market risk security, at the time of buying it was 7.5, it can change. So you can apply this logic. In first quarter, so you will have to calculate interest accruals as per 7.5. So in quarter two, you might see, equation it will change. So in the first quarter, update your accruals for Jan to Feb with this calculation only. And then 7,600 for second quarter. Go and check in your system also. So if you see the change in the accruals pattern, so it means that becomes your market risk security. So you will have to check the Bloomberg or IDC or other different that maybe sources which can contains that market risk information or market rate information. And then for quarter three becomes this one. Up to three decimal, which is fine. You don't have to take more and more decimals, otherwise it will create chaos. Then make sure that your decimal numbers means you have 3 or 4 whatever designated decimals which is approved by your management, you can take that only. So ensure that decimal numbers also. And then finally for quarter four, monthly 6,600 here 2,000 half. Six thousand. So this is how your equation changes for accrual setup. Interest payment, total interest payment, yearly totals, accruals. And you might see, let's say if it is quarterly payment date, so you will receive up to the March in the month of April, that that counterparts or let's say issuer will make a payment to you for interest payment. That scenario also you can say it. Generally, government also pays interest payment on quarterly basis. If you see on NSE side, so that information you can verify whether it is a quarterly or yearly stock in upper circuit, lower circuit. Wow, I can see some modification or change. It's good. NSE data, market data for fixed and debt coupon dates. Regular coupon statements every quarter they can get an interest payment. Mm. See face value of the securities which is different, but limited. Sorry, last trade price, not limited. My bad. Last trade price, which is something different, right? And interest payment, if you see, 10.25 for per year, highest I believe interest payment that this institution is providing. Oh, there are many more others as well. Stable rating, Dhani loans, highest interest payment. Navi Finance, again, highest interest payment. ACL Finance, highest interest payment. So they are paying interest payment very high. All right. There are other institutions also they have taken. Let me check with GSEC means government securities. See, T bills, government issued T bills also. T bills, T bills, T bills. Face value, open price, high, low, tradable price, which is something different. If I select this one to understand by quantity only 500%. Hmm. Show description. So you can check the interest payment cycle also or maturity cycle also with the securities, right? And Bloomberg or other institutions they provide if you check this security description with this eyes in, so they provide security description, face value or total price and everything. So they provide it. And corporate securities, so it means normal stock exchanges also they maintain the details for a corporate securities. So you can check it on NSE site as well. So, means stock exchange site. Right. So I'll come to this point where how this will affect on NAV, net assets value of a fund. See, it's an income. So when we talk about income, of course, that income, it will affect on your net assets value of a fund. Now, if I go to the statement, let's say this is your current statement, right? And if I add two securities, let's say one as per, accruals calculation, if I add those securities to create a dummy example, let's say CLO and this two, right? Assume it their investment value, which is this one. Is there any change? See, I'll have to take total investment. So now if you see there is a change in balance. but I'll amend the cash amount by saying purchase investment, and then adjust the cash. Anyways, it will adjust, asset side only when you purchase and sell the securities, and that won't affect on the net assets value of a fund. Cash which will out. So total cash amount, let's say 2,05,000. So that you need to minus 2,05,000. Yeah, there is no change in NAV. So this is the scenario which you can now record it first. So assume it's a pre-interest payment scenario. This is an this is a pre-interest payment receivable scenario, or pre that income uh, application or accounting scenario. So now we have NAV which is 6,42,000. So this is becomes your stale NAV. Stale NAV means now old NAV, right? So this NAV you can record it somewhere to ensure whether this income, your accruals create impact on NAV or not. Now I'm going to create accruals. Check your accrued income book, right? When you checked it, then you got to know there are two securities. One is CLO tranche, and another one is FRN. Same securities you can confirm with this statement as well. So investment statement. That investment statement also, let's say, give the same information to you where TCS and FRN government bonds, which are already updated in this system, or let's say balance it. So it means you have now got a confirmation. Next step would be to verify how much income that is been generated. Let's assume it you're doing monthly accounting. If you're doing monthly accounting, so it means your books will be closed on 10th of September here only, right? And this is a weeks of time which you have, and you're doing accounting now. So you can calculate accruals for both the securities. Here depends on your purchase date, and that's what I said. Start date and end date is a very important one. Without that, you cannot calculate accruals. If the start date is 1st of Jan, so it means you can calculate accruals for year to date. So it means for entire duration, you can calculate the accruals, right? So let's assume it for, I would say date. For particular this security, I'll consider it was purchased on start date. Start date and end date. Start date which is first July, right? And end date. End date, it means when you sell the security, so that becomes your end date. But even if you want to calculate accruals for that particular duration, then also you can update the date, right? End date of that particular period. Right? Let's say 30th September. Is it a 30 or 13th of September? 30 September. Then 2020. You can calculate accruals for 30 days. Same for this as well. Let's say for both the securities, we have a same duration for a 30 days, 30 days. Apart from that, means in a system, you might say, days as well. For how many days you can calculate the interest payment. Starting date minus your ending date, or it can be ending date minus your starting date. Or if you just consider convention 30 days for each month, so that becomes 3 months. So it means for a 90 days you can calculate here. for 90 days. You can calculate here. So now you have a data and everything. So just update that numbers. If I calculate the interest payment for this period, so it becomes 1900 accrued amount, right? So total accrued it becomes 1900. July to September. Same I can apply to this as well. July to September. 2500, 2500. Just do the total. 4400. Create the accruals now. First, post the accounting entry in the system. Interest account debit to interest income account. So that would be 4400. 4400. Same now, you can refer the journal entry and update or create the records or update the, I would say, interest or receivables. Total interest receivables that you can update, which is 440. Same you can update here. So this is becomes your non-cash adjustment. There is no cash involved, non-cash adjustment. So sometime you may expect question like what are the non-cash adjustment? Accruals becomes your non-cash adjustment. Whatever accruals, expense, income, whatever that you have. If you adjust that, that becomes your non-cash adjustment. Okay. And same, if you go and check the accounting entry contains information for uh, to interest income and interest receivable. Receivable that we have recorded now to the asset side balance sheet, right? And income that you need to record it to the P&L. I'll go to the P&L because otherwise if you see there is a change of 4500, so I'll have to adjust that change, and if I don't update on P&L then I won't be able to adjust it. So total interest receivables which we have 4400. So total income, is there any change now? No change. Why no change? Oops. Interest receivable 1,30,000. Okay, yeah, got it. Now we have updated. Yes, 129. All right. So just calculate the total expenses, whatever expenses that you have. This one, direct bank fees, other expenses. So I believe total expenses, if I calculate, total it means I'll put all expenses in one category and can calculate it. So this total expenses, all right, you can debit from the total income. Total income you have, which is 1,29,000. So just debit from it. So I'll just cross verify it. This minus this. It becomes 121,049, and this exactly same you can adjust here. Right. P&L adjustment 121,049. I believe already updated 049. So now I'll check that sheet. Yeah, this difference is adjusted now. But what about the NAV? So check the NAV difference. Check the NAV difference post post adjustment NAV. How you can calculate post adjustment? Your stale NAV minus your current market NAV, or else vice versa, or other way around. Your current NAV minus your stale NAV. If there is a difference of 4,400, so it means one interest adjustment, if you see that we have adjusted, and this is what that affected on net assets value of a fund. And if you calculate NAV for per unit at the moment, just calculate it to see per unit impact. If you want to calculate total current NAV divided by number of units, which we have 10 for per unit, 64,699. Same if I calculate here divided by 10, so that becomes 64,299 per unit difference. If I calculate, so that becomes 440 for per unit. So it means interest payment adjustments that affect on your net assets value of a fund. All right. So we are done with interest payments. Now you can unmute and ask your questions. Whatever questions that you have, you can ask around interest payment and all. So this will applies to the all fixed income securities. It can be money market, it can be loans, it can be bond market, right? Loan market. It can be any where if you see word like interest payment, then it means you need to apply the same treatment. Start date, end date, which is important. Interest rate, whether it is floating or fixed, that is also important. Apart from that, days or convention, that is also important. And if you say sometime IRR, or maybe that if the DCS factor is applied or not. DCF factor application, which is not mandate, it's optional. If you want, you can apply it. If you don't want, don't apply it. Simple. It's optional for a fund manager. And apart from that, you would see other terminologies where floor interest rate. Floor interest rate, it means floor. It means what is the difference between top and bottom? Bottom, it means ground line, right? Top, it means your ceiling, you can say, correct? So you would see terminologies in interest market, which is ceiling interest rate. So it means higher interest rate. Floor interest rate. So it means lowest interest rate, right? So always see, buyer always try to buy, always buyer try to buy at
Yeah, right.
higher, right?
Yes.
So it means ceiling interest rate. And what about floor then? Always seller try to sell at
Lower, right?
lower rate. So the logic is beyond that, it should not go. So it means if the market interest rate is, let's say, 5 and floor interest rate is 4.9. So the minimum expectation is, again, those are theoretical terms, so that you can relate while selling the securities. A fund manager follow the same logic. So they check it out. Okay, let's say 4.49 is the interest rate. So I would at least expect floor rate. This is how. And nowadays, so while calculating interest payments, so we have a different structure for interest payment. So which is sonar for sonar. So now we don't have a LIBOR and all, right? LIBOR, which has been seized. Even though IBOR, MBOR, Mumbai Bank offered interest rates, UK BOR, Euro BOR, there were a lot of BORs. Now we don't have a BORs. So we have now, means for a UK market, they have designed their different interest payment, overnight interest payment system. So central bank will calculate the interest payment for a per day basis, and that will roll out. So that interest payment will applicable to the all stakeholders for the part of that particular ecosystem. Initially it was very different. See, LIBOR and all, you can manipulate it. If you are a, let's say, big bank, or you have a, let's say, large market cap, then you can dominate the market and you can sell the interest payments and all at a higher rate. Means you can sell the loans at a higher interest rates also. So that's how you can dominate the market. But at the moment, so when this SOFR and other terms come into picture, so it means central bank now will take a stand in this market. Central bank will take the quotations, evaluate it, and then post. They'll publish that data, and that interest payment will applicable to all now. Because LIBOR was risky. Even MIBOR, even though we have a MIBOR, but now even though Indian banking system is also looking for a reform, how central bank will come into picture and they'll decide everything so that no one can manipulate it in that way. So you might see reform in our Indian market as well very soon. I'm expecting that. SOFR, Sonar, Sterling overnight interest rate. But yeah, so accrual setup, when you say accrual setup, it means this process come into picture. And same accruals that create impacts on net assets value of a fund also. From an interview perspective, you may expect questions on accrual accounting entries, right? Then whether that accruals create impacts on fund, that NAV for per unit or not. So you may expect questions on that part also. How we calculate the accruals for fixed income securities, what input that is needed, means start date, end date, trade date, settlement date, days, convention, right? And rest. See, as I said, so in a system, if you update all this information, system calculate everything. You just need to verify and update your books for NAV calculation. That's all.
So I have one question. If there is a defaulting payment of any bond, then we have to reverse all accruals and write off the principal amount, right?
Yeah, so that becomes your actually, whatever interest payment you have, so you can convert that into bad debts.
Yeah.
Meanwhile, right? So you might expect, let's say, recovery of that particular amount, not maybe 100%, but might be you can see little bit, right? That sort. See, when you invest in bonds, so government or NCLTs or the other agencies, they'll interfere and they'll sell that assets. Once they sell that assets, so you will receive redemption amount. Correct.
But we will not receive full amount. Maybe sometime we
Depends on
will
the
be,
asset quality, right?
yeah.
If you are taking loans, so it means already your asset quality which is dented, and that's what you're taking loans.
But
So I'll tell you one story. Let's say Vedanta Group. Vedanta Group earned 21,000 or 28,000 crore profit something for a particular year. Last year, I believe, right? But that company distributed dividend 41,000 crore, right? And now this company is asking for a funding, so that they're looking for a 2,000 crore funding. So they issued bonds in the market with the higher interest rates. So my question is, they had a profit which is around 28,000 crore. They had even liquid cash in their books of account. Why did they distribute? I was very skeptic when they announced that, and then I did, because nowadays I'm doing kind of forensic audit or research on a financial crimes and all. And then I realized, so that guy Anil Agrawal, who is holding around 80% holding in Vedanta, 70 around 69 point something, which is directly, and 10% indirectly, only 10% holding, or 20% holding if you see the other people, general public and other institutions, they're holding it. So if you calculate, out of 41,000 crore, almost 35,000 crore amount received to that founder or promoters only. So this is a big scandal. This will reveal, not now, but if you look at a larger picture, within a 2 to 3 years, this guy will declare. Now, what he'll do, I'll tell you. He'll raise the funds again, right? This fraud you cannot, what I would say, means even the regulator cannot do anything. See, dividend you can distribute if you have an amount. It's legal, but this is a very smart fraud. And if you invest in their bonds, and what if they announce bankruptcy? And I'm sure that they don't have a means strong asset quality. So ultimately, whatever amount that you would invest it in their bond scheme, so that will definitely affect maybe up to 50%, 60%, 70%. And then that you can convert it into, then if you see the same scenario, then you will have to convert that into bad debts. There are two things: impairment losses, right? So that you can directly remove it. If you
Yes.
if you want, for that particular year, highlight that. So this asset now converted into bad debts, and from next
Right.
year onwards, write off it or remove that out. So it's a loss, right? Uh,
Yes.
convert
Got
that
it.
into, yes, convert that into asset. Once you convert into loss, so it means you are transferring that assets to the P&L. Simple. So once you transfer it to the P&L, consider it for that particular year, and then remove it. You don't have any other option. But if you have a possibility where, so that company can process redemption and they will receive some amount, then you can carry as a bad debt also.
Okay. Got it.
Got it?
Yeah.
Sri, any question? I'm done.
Yeah. Nothing for now.